Being the owner of a retirement planning firm and a tax prep firm, I've seen hundreds of people use these 7 investments not only to reduce taxes, but also to create tax free growth and tax free income. 4 of them you might know and you've heard before, but 3 of them are a little bit different. And many people have not explored these options. So I want to make sure that you know about these ones too. And if I haven't met you yet, I'm Dave Zoller. I own Streamline Financial. It's a wealth management firm in Illinois. And then I've got a tax planning firm called Zoller Swanson as well. And my team and I, we've been helping people retire personally for the last decade and a half. And we really are focused on simplifying their financial life and just retiring with confidence. The goal of this channel, though, is to just share the tips and the strategies that have worked for successful retirees and share it with you. So let's get to the first investment. This is one that I'd say isn't for everyone, but it can offer a big tax incentive. So it's worth mentioning. And what it is the exploration and drilling and production of oil and gas resources. This type of investment, oil and gas, it's often made through a partnership, or it's really a pool of money from multiple investors. So multiple people are putting it in the pool of money or a fund here. And this fund then funds the operations of the rig or the oil and gas partnership. And then the partners receive the profits and the losses based on the investment share that they have. Now, what are the tax benefits? So the first question is it tax deductible? So let me show you just on this simple thing. So first, is there no tax on the contribution? Is it deductible? And this would get a green check mark, yes. Because one of the big advantages, the tax advantages, is the ability to deduct the intangible drilling costs, or IDCs, which sometimes equate to, could be 60 to 80% of the actual investment amount. So there's one other investment in this video that that beats that, but IDCs, they include expenses related to things like the labor or the chemicals or the other non-salvageable costs that happen during drilling. And these costs, they're usually fully deductible in the year that they occur. And to put some numbers to it, take the investor he had a big income this year, and the tax projections that he runs with his tax planning firm shows big taxes owed as well. So if he invested $100,000, he was able to deduct over $60,000 on his tax return for that year. Now, the nice thing about participation in oil and gas is that the deduction can often offset other income, which is a big deal because it's almost like well, I'll get to real estate coming up as a sneak peek, but this idea of offsetting other income, whether it's W-2 income or your just other business income, if you're a business owner, or other investment income. So it's kind of like when you think about real estate, you can't do that with your real estate depreciation or deductions unless you meet specific criteria. And I'll mention that one next and give you some of the details. But back to oil and gas, do you pay tax on the income? Well, I'd say this is green as well because you don't pay tax on all of it. Typically, 15% of the income is not taxed due to something called depletion. So it's kind of like depreciation when you've got a real estate investment, but the depletion allowance, that lets them deduct a portion of that income based on depletion of the oil and gas reserves. And then finally, is there any tax on the sale? And I would say this one is a red. So there's tax recognized on the sale, but really the goal here is to receive cash flow each year from production. But the big tax advantage that happens in year one, but maybe year two as well. But if the investment is sold and it's at a gain, then it's going to be taxable. So you can see a lot of the tax benefits here for this one. But remember, this isn't for everyone. This can be really volatile, right? There's some uncontrollable risks, things like fluctuations with commodity prices or regulatory changes, or just the drilling uncertainties is a big deal, right? You don't know. So it is higher risk in my opinion. But now let's move on to real estate investments as number two. Now, not your residence, your primary residence real estate, but income producing properties or investments. So the first question is Is it taxable? Let's see. So for real estate, I'd give this a green. You can get a deduction here, but I'm going to put a little asterisk here. It all looks the same, but the asterisk, I'll explain what that means. So let's say you invest $1 million. You're going to start depreciating the real estate asset in year one, right? And also, there's a strategy that investments or investors can use to accelerate the depreciation of the building and get more of a deduction in year one. So larger deductions, uh, so I would consider that a deductible investment, and I'll give you a little bit more info coming up. But that offsets